Watch prices are coming down. A lot of Rolex models are starting to become available for purchase at authorized dealers. Most other brands are available below retail on the secondary market, and I've even heard that some ADs are starting to give discounts. What's going on, why, and what does this mean? It's time for a market update. Let's dive in. Where we are. We all know the high-level contours of the story. From 2019 to 2022, things kind of went bananas in terms of prices and availability. Everything considered desirable was not just unavailable, but was so unavailable that there was a massive market for selling a lot of watches well above retail on the secondary market. Flippers, grey market dealers, and people touting watches as investments were what got spoken about. What's important though is that 2019 to 2022 was the peak. The Rolex hype started picking up already back in 2015, about the time of the Ceramic Daytona release. All the way from 2015 and forward, companies were getting their act together. In 2018, Cartier and other brands actually bought back stock basically to protect their brands. There were way too many watches in circulation, and watch brands had for a lot of years been forcing dealers to take large amounts of stock of popular but also unpopular models. So for every Omega 300M, the ADs were also saddled with having to sell some random gem set Omega DeVille that practically nobody wanted. The model for watch manufacturers was to pump volumes. They would fill display cases and go for volume, focusing on the volume that went to the ADs. But as we all know, this generated a massive glut of stock. Piles of watches were unsold, and ADs rightly dumped them to the secondary market, and this started tanking watch manufacturers' brand perception. I mean, why would you pay full price when you could get 20 or 30 or 40% off on the secondary market? So they tightened up production. They dialed everything back, and at the same time, the economy went up. COVID happened, and nobody traveled, so everybody bought watches instead, and prices went up, while availability went down. And now, prices are coming down. I said this in the video about a couple of months back. The Rolex heat map would contract, the two-tone would become available, the edge models would become available. Well, that's where we are. Same goes for any other brand. If you want a green dial Seamaster 300M, it was hard to get a while back. Now it's a walk-in. The IWC Ingenieur, it's more or less a walk-in. You'll have it within a month. The Reverso Chrono, it's not a big waitlist. Richemont's watch business contracted in Q3 2023. And technically, they said they stayed stable in Q4 2023. But that's only because they did a bit of exchange rate balance sheet magic, and then they conveniently glossed over the fact that Q4 is the quarter where consumers typically spend the most money, and they didn't. The Christmas uptick didn't happen, which it should have. Richard Mille is practically being given away on the secondary market. A lot of high-end brands, for a variety of reasons, are nowhere near as desirable as they have been. Swatch just released their annual report, and they still did very, very well for themselves in 2023, but nowhere near as well as 2022. They did note a slowdown towards the end of 2023 also. They're still optimistic for 2024, but there were also statements indicating that the frenzy that they'd been used to was over. LVMH also saw a slowdown in their watch business results. And you may also have noticed that Watches of Switzerland are forecasting a massive slowdown. These are the guys on the front lines, so they really know what's up. Depending on where you are in the world, the picture looks a little bit different. Europe is still fairly pessimistic, and it seems to shine through in Europeans' purchasing behavior when it comes to watches. They're buying less. Emerging markets like the Middle East and parts of Asia are growing at a much faster pace, which is not completely unsurprising. These are regions where more millionaires are created every single day compared to anywhere else in the world. Deloitte, the global consulting firm, has an interesting report that they publish every year, and the 2023 report is super interesting. One of the things they talk about in the report is how consumers see value and price versus brand. In the US, France, and Germany, consumers are leaning more towards a value to price ratio as their first parameter to make a purchase decision. India, the Emirates, China, they all very much still look at brand image first. This speaks to different buying behavior in general, but also to purchasing willingness. As willingness goes down, so does the tendency to choose brand over value. So those of us that are in the West are going to be much more critical in the coming months and years when it comes to what we perceive as value for money. The Deloitte report has a whole lot of other super interesting data. In 2022, 20% of people who were on a waitlist gave up and bought something else. In 2023, that number was up to 30%. Fewer people saw watches as a long-term investment. Fewer people felt that the resale value of a watch was going to be higher because they had to wait for it. When asking the manufacturers, the majority seemed to accept that people are tired of waiting for stock. And more importantly, they'll either choose to buy from another brand or buy nothing at all. All in all, the fire days are over. There's some limited optimism on the producer side, but it's nowhere near as optimistic as they have been. It's not a crash, but manufacturers can't expect to have empty AD windows in 2024. There are pieces that are going to be gathering dust. Why is this happening? Well, because of inflation, because the economy slowed, because people don't have as much disposable income as they used to have. The investors and the flippers have to some extent drifted away, and finally the watchmakers have gotten greedy. The watchmakers raised prices far more than they should have. A lot of the business propositions they put into place were made based on data from COVID times. A watch producer is slow to adjust. Watch models, releases, production numbers are not something you turn around from one day to the next. The decisions they made in 2021 and 2022 are impacting now in late 2023 and here in early 2024. That's why we saw so many releases in 2023. It was a glut of models to deliver to a rabid 2022 market. In short, consumers ran out of spare cash and got tired of waiting for the models they couldn't get. We still get hyped for cool watches, but we're just a little bit more hesitant, that bit more critical. Is it going to continue? Yes, for a while. There's this concept called the bullwhip effect. It works something like this. An AD has, let's say, 5 Seamaster 300Ms. The AD has 10 customers walk in and say, I want a 300M. He sells 5 and he has 5 leave who never got anything. Now he has to refill his stock. So he calls the middleman, the distributor, and says, I think maybe 12. Give me 12 because I want to be sure that I have enough for the customers. Every AD does that. The middleman, he now has orders for 750 watches. He got 250 last time, but he also adds a little bit because he has to say, well, what if I'm under ordering? So instead of 750, things are going well, I'm going to order 1,000 at Omega. Omega goes to the people that help them with parts for movements to say, we need for 1,200 movements or 1,300 movements. Omega does this for all their materials. And suddenly you have far more material and ultimately far more watches making their way through the system because everybody is communicating optimism through the value chain. This leads to overproduction. Generally speaking, manufacturers are a lot better at managing their supply chains today than they were in 2018, but they're not perfect. We are going to have some level of oversupply, also because the brands also don't want to underdeliver because there's so much antipathy that has been generated by stock shortages. Then you add to that people's demand is just lower. So you've got excess supply and limited demand. That means further drops, more availability, more access. I don't necessarily see a realistic scenario where there's a bottom falling out of the market, but we are going to get back to a more classic level where most watches have a curb tax and will be possible to pick up below retail. Depending on the brand, depending on the popularity of the model, that curb tax is going to be bigger or smaller. Swatch and all the others can still be a little bit optimistic for 2024, but they're going to have to work a whole lot more to get a hold of our money. The next question is how manufacturers will deal with this trend, and I have a couple of theories that I think are worth expanding on. Any brand that had a dream of moving upscale price-wise is going to have to put that idea on the back burner. When you see slowing demand, the solution is not to raise your prices by 7 or 8 or 9 or 30%. You will be forced to consider your value proposition and your pricing. You'll still want to maintain your margin per watch, so you want to recoup the extra costs incurred because of high inflation, but you ideally want to convince buyers to come back, and that is by keeping price increases to a minimum. Just look at Rolex. Their price increases this year were way more humble compared to what we've been used to. In some markets, prices are completely unchanged. Greed is being curbed for a while. Then there's limited editions. Limited releases like the SJE 093 or an Ed White are great when you have hyper demand, but when people are on the fence about a regular 3861 Speedmaster, you as a manufacturer are going to worry about whether that extra expense that goes into those limited release creations is worth the risk. You have to at least consider cutting back on the number of limited releases you have. You have to weigh how popular that limited release is going to be and whether you can generate volume in some other way. When you're making money hand over fist, you can take chances. When you're seeing stuff sitting on the shelf, that third Ed White variant might not be the business decision you want to make. Then there's variety. If you're under pressure on your volumes, what do you do with new releases? Intuitively, do you try to throw out more variants, more models, more options, or do you stick with what you know works? Generally, the bigger a brand is, the more likely they are to be risk averse. They'll take less chances. It's not necessarily the right strategy, but they won't be thinking about gaining market share. They'll be worrying about protecting the share that they have. So generally, I would put my money on more safe releases and less variety for a period of time because it's the safe approach. Like I said, not necessarily the right approach, but it's the safe approach. When it comes to marketing, this is a time where things are going to be tough. Generally speaking, the brands that market will win. This is almost a truism. Swatch even said as much in their outlook for 2024. They've realized that the activities like the Swatch collabs drive massive sales. If you don't scream in the crowd, nobody's going to notice you. But the thing is, the moment those numbers go down, there's always a business tendency to cut back on the marketing to protect the bottom line. I think the ones that go all in on marketing are the ones that will perform better than the rest. What I also think we'll see, and are already starting to see, is the move of many consumers towards smaller, more niche brands that convey value. I think Formex and Christopher Ward are really good examples of this. Formex offers you a COSC-certified steel 300-meter water resistance watch for under $3,000. It's even under $2,000 actually, depending on the market you're in. Same goes for the Christopher Ward 12. The Speedmaster has doubled in price in the last 5 years. An Aquaterra is a phenomenal watch, but there are options at half the price that some consumers are going to find compelling. I don't think it's unreasonable to see a drift away from some of those massive corporate brands that have just gotten way too expensive for what you get. Obviously, the manufacturers will react to that. So down the road, that drift will force brands like Omega to innovate. A lot of bigger brands, I believe, have been resting on their laurels, living off of past successes, but they really haven't done a lot in terms of movement innovations, bracelet innovations, and all that sort of stuff. Sub 3,000 in non-big brands, you can get quick release bracelets, easy adjust bracelet, COSC certification, excellent lume. The gap between an off-the-shelf chronometer grade Sellita and a Kenissi movement or an ETA Swatch Group movement is not as big as the price would suggest. This, right now, is the time where Omega and others need to step up their game and thin down their movements to broadly expand spy rate technology and increase accuracy in their movements without lowering frequency and without throwing in synthetic parts in their movements. The big brands will have to consider how they're going to justify their price premiums in terms of specifications and finishing. They can't rest on their laurels anymore when it comes to specs. When it comes to high-end brands, I think we're going to see a contraction in demand in general. The more peripheral brands that haven't been super hot like Vacheron are going to be under way more pressure than Patek. Just like that heat map I have for Rolex where there's this core of perpetually desirable models, so too do I think that there are one or two brands in the high-end like Patek and Rolex that buyers are going to drift towards when interest wanes. Hublot, Richard Mille, Journe, I can easily see some of their clients drifting towards Patek and high-end Rolex for that matter. The next couple of years are going to be an upcycle for those in the enthusiast community. We're going to have an easier time getting a hold of the watches we want, and we may even get them below retail. Eventually, the economy will rebound more consistently. The latest US consumer report shows that Americans are ever so slowly starting to believe that the economy is bouncing back. And then, demand will come back. And we'll repeat this cycle because big watch brands don't really learn. Generally, businesses like these do not learn. We flock to them, they drive up prices. We run away, and the cycle continues. But for right now, availability and the regular customer is king. Those were my thoughts. What are yours? Let me know in the comments. Like, subscribe. Cheers.